Anthony, first of all, what do you think accounts for this latest bout of retail enthusiasm?
I think this is another meme stock driven short squeeze. The short interest in Bed Bath & Beyond was quite high. And so, I think that, it's a usual cast of characters, the Wall Street Bets crowd, pushing the stock up. There certainly are no fundamental reasons for the move that we've seen. If anything, the fundamental picture has actually gotten worse over the last several weeks.
And maybe that's what sparked the increase in short interest. So you think the stock is a short, basically, but can the retail army spoil the result of that trade for you?
Well, I think it goes back to that old saying, the market can remain irrational longer than you and I can remain solvent. I mean, I could certainly see this continuing in the short term, but in the long term, the stock price is going to have to reflect the fundamentals of the business, and the fundamentals of this business are terrible and only getting worse.
So let's just call this Bed Bath & Bye-bye, right? I mean, that's kind of what we're talking about here, BBBY. Their debt picture is extremely serious, isn't it? I mean, they've got a lot coming due, maybe not so much next year, but the year after. Is it 2024?
That's correct. So they have about $300 million, a little less than $300 million of debt that comes due in 2024. And then they've got other debt maturities in 2034 and 2044. But I'm less worried about the debt maturities. I'm more worried about their liquidity position. It's really deteriorating at a very fast rate. They're down to about $100 million in cash. They already have drawn $200 million on their credit facility. That's what I'm more concerned about, particularly if the suppliers lose faith and start basically giving them more onerous terms. Well,
that's a key question, because if the vendors see that they don't have cash, are the vendors going to require more money up front to give them the laundry baskets and knives and plates and linens that they do?
I mean, that really is a $64,000 question. To give you a little bit of history here, I mean, that's what did in Circuit City. Circuit City, at the time that they went bankrupt, I mean, they were struggling, but not nearly as bad as Bed Bath & Beyond is. They also had a lot less debt, but the vendors just lost faith and they ended up in a death spiral. And that's the scenario that I believe we could see with Bed Bath & Beyond.
What, if anything, could avoid that scenario?
So, look, the only Hail Mary pass that I see at this point is if they raise equity, if they are able to basically sell a bunch of new stock and pay down debt and essentially, forestall their demise. We saw GameStop do it. We saw AMC do it. The problem with that is that it would be incredibly diluted to their existing shareholders. And by the way, they're going to need to raise a lot of cash. I mean, we're talking probably at least $500 million, at least enough to repay the $200 million that they have outstanding on their asset-based credit facility and the $284 million that's coming due in 2024.
Shouldn't they do that right now then, at this moment, with the stock where it is?
Well, two things. First off, it's a lot easier said than done. The other thing is that, when GameStop in particular did it, I mean, the stock price was significantly higher. So, I mean, let's give you some numbers here. Let's just say the stock was at $20 and they issued $500 million of stock. That would be 25 million new shares issued. They only have 80 million shares outstanding right now. So that would be a ton of dilution to their existing shareholders.
Shepard Smith here. Thanks for watching CNBC on YouTube.